Hey there, it's Krista from the Accounting Doctor, your trusted ally in all things taxes. Business owners, let's talk about something no one wants to deal with, an IRS audit. If you're running a business, you need to know what can trigger one. Today, I'm breaking down the most common IRS red flags for business owners, what gets the IRS's attention, and how to avoid unnecessary scrutiny. Let's get into it. The IRS doesn't audit business owners randomly. They use computerized screening to compare tax returns to industry norms. If something looks off, your return might be flagged for a closer look. Other times, audits may happen due to a random selection, tip-offs, or issues with a previous return. But most of the time, it's because of something on your tax return that doesn't quite add up. One of the biggest red flags is claiming way more deductions than the IRS expects for your income level. If your business is reporting $100,000 in revenue, but $95,000 in deductions, the IRS is going to ask, how are you staying in business? Now, that does not mean you shouldn't take legitimate deductions, but they need to be reasonable and well documented. Keep detailed receipts, invoices, and logs to back up every deduction in case of an IRS audit. This one is a biggie, mixing personal and business expenses. If you're writing off lavish meals, first-class flights, or personal shopping trips as business expenses without a clear justification, the IRS will take notice. To protect yourself, always use a separate business bank account and credit card. Keep personal and business spending apart. When in doubt, document why an expense is necessary for your business. The IRS loves to crack down on businesses that misclassify workers as an independent contractor instead of employees. Why? Because businesses don't have to withhold payroll taxes for an independent contractor, but they do for employees. If you're controlling how, when, and where someone works, they may actually be an employee in the IRS's eyes. And misclassifying them could mean penalties and back taxes. If you're unsure, talk to a tax professional before the IRS comes knocking. The IRS keeps a very close eye on businesses that handle a lot of cash or deal in cryptocurrency. If you make large cash deposits over a certain amount, banks are required to report them. And if you accept cryptocurrency payments but don't report them properly, the IRS considers that tax evasion. The key here, keep records of all cash and crypto transactions and report them accurately. The IRS has become much stricter on this, and failing to disclose could result in serious penalties. If your business is always reporting losses, the IRS may suspect you're running a hobby instead of a legitimate business. The IRS expects most businesses to turn a profit within 3 out of 5 years. There are a few exceptions. If your business isn't profitable yet, you need to be able to prove that you're actively working to grow it, keeping paper records, marketing, and showing clear business intent. Otherwise, the IRS might deny your deductions altogether. So, how do you protect yourself from an audit? First thing to do is report all income accurately. The IRS already gets copies of your 1099s and W-2s, so make sure your returns match it. Number 2 is keep detailed records. Receipts, invoices, mileage logs are your best defense in an audit. Number 3 is separate business and personal finances. Use a dedicated business account and credit card. And last but not least, work with a tax professional. The IRS is tough, but an expert in your corner makes all the difference. The IRS is always watching, but that doesn't mean you have to live in fear of an audit. If you're unsure about anything on your tax return or need help making sure your business stays compliant, let's talk. Call or visit our website for a free consultation. Until next time, stay calm, stay informed, and let us handle the stress for you.